Good morning and a warm welcome to everyone joining us today. Thank you for taking the time to be part of the quarterly tax dialogue series. As you all are aware, the quarterly tax dialogue series is organized by UKGCC and PwC Ghana. My name is Christiana Osei-Mensah, and I will be moderating today's series on the topic double taxation agreements and international tax cooperation, what multinationals need to know. So before we begin, a few quick housekeeping points to note. Your microphone is muted upon joining the webinar to prevent background noise from distracting the speakers and other attendees. Should you want to ask a question during the Q&A session, you can raise your digital hand using the hand raise icon on your screen, and you will then be given the access to speak. You can also submit your questions at any time during the conversation using the Q&A function on your screen. We will attempt to address all these during the Q&A session at the end. I will encourage you to stay to the entire duration of the webinar, as valuable information will be shared throughout the discussion. Please note that this conversation or discussion is being recorded for future distribution purposes. Okay, so with that, we are good to start. Companies are increasingly working and investing across borders. This has increased the importance of having to understand double taxation agreements and its applicability and compliance requirements to assessing its benefits in Ghana. Today's session will focus on one central question: what multinationals really need to know about double taxation agreements in Ghana and Ghana's international tax framework. So to answer this question, we will start by looking at Ghana's double taxation agreements more broadly. What the treaty network look like, how many double taxation agreements Ghana has signed, and how many are actually in force. Based on available information on Ghana GRA's website, I could count about 36 double taxation agreements that have been initiated, and they are all at various stages of completion. So we will know during this conversation how many of these 36 double taxation treaties are actually in force. We will also then talk about what these agreements mean in practice, including their impact on permanent establishments, business profits, and the common ways that multinationals repatriate their profits. We will also touch on Ghana's international tax cooperation framework, including how Ghana with other countries coordinate through exchange of information and other legal mechanisms to resolve tax disputes. Last but not least, but more importantly, we will also look at the compliance and reporting side, how to apply for treaty benefits, the key guidelines to follow, the documentation required, and some of the practical challenges businesses often face when it comes to assessing these benefits. To guide us through this very important conversation, we are happy to be joined by an experienced group of speakers. They have agreed to share their time, their knowledge, their expertise, and their insights on this topic with us. In no particular order, I will first introduce Mr. Noah. So, Mr. Noah, you can say hello before to the team.
Let me show my face.
Yes.
Good morning and hello to everybody. You're all welcome.
Okay. Thank you, Mr. Noah. So, Mr. Daniel Noah is currently a technical advisor at the Ministry of Finance with over 37 years of experience in tax administration and tax policy. He holds a BSc administration from the University of Ghana, an MPhil in taxation from the University of Pretoria, and is a fellow of the Chartered Institute of Taxation, Ghana. He is a vice chairman of the Bureau of the Intergovernmental Negotiating Committee for the UN Framework Convention on International Tax Cooperation and serves as co-lead for Workstream 1, which is responsible for developing the text of the Framework Convention. Our second speaker is Mr. Dauda Mohammed Hafiz Din Esquire. Hi, Mr. Dauda.
Hello, Christine.
Okay. So, Mr. Dauda Mohammed Hafiz Din Esquire is a lawyer, chartered tax practitioner, chartered accountant, and finance professional with extensive experience spanning law, taxation, banking, financial management, audit, treasury, and corporate advisory. He holds an LLM in corporate and commercial law, an MBA in finance, an LLB, a BL, and a BSc in administration, and is a member of both the Institute of Chartered Accountants Ghana and the Chartered Institute of Taxation Ghana. Over the years, he has built a strong multidisciplinary practice in tax, regulation, finance, and business law, advising on corporate, commercial, and cross-border matters. He is an associate at Legal Inc., Lawyers and Notaries, where he advises businesses on tax compliance, structuring, regulatory obligations, commercial transactions, and dispute resolution. Last but not least, I'll introduce our main speaker, Mr. Nana Mensah Otu Esquire. Hi, Mr. Nana Mensah.
Yes,
Good
pleasure.
morning. Okay. So, Mr. Nana Mensah Otu Esquire is an assistant commissioner and head of the International Tax Office of the Ghana Revenue Authority. He serves as the lead negotiator for Ghana's double taxation agreements, international agreements, and mutual agreement procedures. In this role, he supports Ghana's international tax policy and treaty negotiations, contributing to the country's engagement with global tax cooperation frameworks. So I did mention earlier that we have a very able, experienced hand to take us through the conversations today. And I'm very sure after reading their profile, you understand why I said so. So we will kickstart the conversation with a presentation from Mr. Nana Mensah Otu Esquire, after which we will delve into the discussion for today. So without further ado, I will hand over to Mr. Nana Mensah Otu Esquire to take us through his presentation.
Okay. Thank you very much, Christiana, and good morning to all our participants and moderators and fellow panelists. I think Christiana has already made my work quite easier, giving us some basic introduction. So without wasting much time, I will put up my slides for presentation. So kindly bear with me for just a minute. I believe my slide is showing. Everyone can see it.
Yes, we can see it.
Very well, thank you. So once again, good morning, and I will go. Just prompt me if I'm speaking too fast or too slow, so that I can manage the time and also manage what has to be put out for multinational. So as rightly put, per Christiana Ebomo, moderator, the question is double taxation agreements, international tax cooperation, what multinationals need to know. So reflecting on this topic, basically the presentation today will take this format. We'll look at the basic goals of double tax agreement. We'll look at the basic structure of double tax agreement, the DTAs and the tax barriers. Look at the overview of our DTA model articles. Then we'll look at international tax cooperation frameworks, and then we will end with the question and answers. So I will start this morning. As she had earlier indicated, we have 36 initiated double tax agreements, and among these, we have 14 tax treaties that are actually in force and effective. I will show the table of that particular slide for us to know which countries that we have signed agreement with them. So, what is the basic goal of a tax treaty? And basically, tax treaties, as we all know, it is an agreement between two states, and the purpose is that to eliminate double taxation. So, trade barriers or cross-border investments are always inhibited by tax matters. So, countries, come together and then they will sign this agreement with the hope and the purpose that they will eliminate double taxation, where the two states, only one state will tax the income at a particular time, or the two states will share the taxing right and then split the income in accordance with the details or the tenets of the DTA. And so this is a way that double tax agreements come to play to help remove tax barriers that inhibits cross-border trade and investment. And so, as I've already indicated, so normally when you take the double tax agreements, the long title of it, it tells you that, as is in the blue, it says that intending to conclude an agreement for the elimination of double taxation with respect to taxes on income without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangement aimed at obtaining reliefs provided in this or in that particular agreement for the indirect benefits of party. So what this clearly meaning is that in as much as we are seeking to the DTA is seeking to eliminate double taxation, it is also an agreement to eliminate non-double taxation, and also an agreement to eliminate or reduce what we call treaty shopping arrangement. And so that is the two-way or the three-way that the double tax, the basic goal of a tax treaty. So eliminating of double taxation and also prevention of tax evasion and tax avoidance, and also prevention of what we call non-double taxation, because people may decide that they are resident in one country, but they are not actually resident for tax purposes. And they may want to use what we call conduit arrangements to benefit from the DTA. And the DTA clearly provides that where evidence and fact have been obtained, then each of the contracting states can decide to deny the benefits of the tax treaty. So primarily, I'll move on to the structure of a tax treaty. We have bilateral treaty that is between two states, and then we have multilateral or regional tax treaties. And some, once in Ghana, for example, once a treaty is duly signed by the president or his authorized rep, the treaty is taken through Parliament for ratification in accordance with the tenet of the Constitution of the Republic of Ghana. And once that ratification is done, then the treaty forms part of our domestic laws. But that notwithstanding, with this becoming part of our domestic law, is still seen and governed as an international instrument, which is governed by Vienna law on treaties. And for that matter, in case that there is a conflict between the tax treaty and the domestic law, the tax treaty prevails over the domestic law to the extent of the inconsistency between the two frameworks. That is the domestic tax law and the tax treaty. And generally, the tax treaties follow a particular format or a structure, either the UN or the OECD or the ATAF models. And countries make variations. So Ghana is more pro-UN and ATAF model that we follow, and also subjected to our domestic tax policy needs and developmental agenda. So this is just the basic structure of a tax treaty. Now, what is more important for us as we have gathered today? How does tax treaty remove tax barriers that inhibits cross-border transaction and investments? And this is what, as the topic for today, mainly rests on what multinationals need to know why we are into this agreement. And the first on the list is the elimination of double taxation, as I mentioned at the intro level. And then the second is certainty. The tax treaties provide certainty of tax treatment for taxpayers and governments as a whole. It also provides reduced tax rates in some instances, or almost all instances for multinationals. It also affords both the tax administration and then the multinationals to have a lower compliance cost. Of course, I'll go into further of these each one of these items in the next slides. Prevention of fiscal evasion and assistance in collection of taxes. And then the last but not least, we have the resolution of tax dispute, which is also one of the key drivers of how tax treaties help to remove tax barriers for multinationals and for both the tax administration across the globe, including Ghana. Now, elimination of double taxation. Without tax treaty, there's something what you call juridical or economic double taxation. I won't bore you with all the technical matters too much here, but juridical double taxation basically means that we have the same taxpayer in Ghana. He has received an income, and then the two states are also claiming taxing right over that particular income based on the way the tax laws of both countries have been structured. So I earn an income in Ghana. I'm an ordinary resident in Ghana for tax purposes, and then I move into Nigeria to perform certain services. But then before I went to Nigeria, the payment is actually paid from Ghana to me because I perform the services either in Ghana or even in Nigeria, but the payment is sourced from Ghana. Ghana tax law provides that once the payment is coming out of Ghana and is not exempt, Ghana will tax it. Nigeria also says that I've been in Nigeria for maybe couple of days based on their tax law, or based on their tax law, once the money is accruing to me in Nigeria, Nigeria will tax it. So in that sense, I'm the same taxpayer receiving the same income, Ghana taxing it, Nigeria taxing it in my hands. That becomes what you call judicial. And without the DTAs, $100, for example, if the income I'm receiving will be subject to a tax rate at in my hands at these two states. And for that matter, this is what we call restriction to cross-border investment. And so the DTA comes in to say that no, if you are a tax resident in Ghana and you perform services in Nigeria and payment is made from Ghana to you, the DTA will then come up with how the taxing right should be allocated. So the DTA will say, okay, Ghana can tax to the tune of this amount, or Ghana can tax the full amount and Nigeria can take the difference, or Nigeria can tax the full amount, Ghana cannot tax. So that is the beauty of how the DTAs come to help multinationals, so that multinationals will not suffer unduly taxation of their income in the hands of, in their hands, but in two different states. So they can be assured that they can have, their income duly taxed either once or shared among the two contracting states. So mostly the DTAs are around this, but there's another one, what we call economic double taxation, which basically it's talking about taxation of an income twice, but in the hands of two different, in the hands of, not in the hands of the same taxpayer. So meaning it's the hands of two different taxpayers. So we have the profit of the business being taxed, and the dividend that is being distributed to the shareholders also being taxed in the hands of the shareholders. So technically, you can say that it is a double taxation. So that is also another mechanism. But of course, in the DTAs afford taxpayers the opportunity to eliminate this. Without a DTA, both profits will be taxed accordingly, and then without opportunity to even get what we call either eliminating double taxation through either credit method or an exemption method. So I'll move on to but let me quickly just state that normally the treaty source rule will apply if only it is in conflict with the domestic law. What that means is that the tax treaty generally don't impose taxation. The source rules have clearly been defined in our various domestic tax laws of each contracting state. But then the tax treaty sometimes make some adjustment or provisions by, like I said, assigning the taxing right to the other contracting state. When that happens, then in that circumstances, the treaty rule will then be applied as against the domestic conflict. So, for example, if your domestic law provides that source rules, once you sell the shares in a company, you have made a capital gains, and so Ghana should tax it. But then in the treaty, some treaty will provide that once the shares is just in relation to companies that do not derive their the whole that directly or indirectly from immovable property, then the taxing right should be deferred to or to be assigned to the resident state of the person who sold those shares. So that will then mean that the treaty rule will then apply when it comes to the source rule in that regard, but not the domestic law. But other than that, normally the source rules as been provided for domestic law would always be in place. But then with the modification by the DTAs will then apply. Basically, as I said, once taxing right has been assigned and you have been taxed, the example I gave, my income has been taxed in Ghana, but I'm ordinary resident in Ghana. So the DTA provides that my resident state, that is Ghana, is supposed to give me either credit or exemption. That is by way of eliminating double taxation. So the DTA normally provides that either, the resident state should always eliminate double taxation by giving the person either a credit or an exemption mechanism, and that is always provided for in the taxation laws of the respective states. So Ghana, for example, usually we do what we call the credit method, to the extent that how much tax that we have been taxed in the other jurisdiction is what will be credited to you as such. The next is about certainty of tax treatment. And as I said, the treaty is governed by the Vienna Convention on Law of Treaties. And for that matter, between the two states, this agreement has to be interpreted in a fair and good faith as well. So, as I said, the treaty has provided for rates, it has given taxing rights, it has given share where it is shared, where it is not shared. And so taxpayers and tax authorities know that until or unless this treaty is terminated or reviewed, whatever terms that have been agreed upon is what has to be followed by both two states and also the taxpayers. So taxpayers can plan and know that in the next 10 years, this is how my royalties, my interests, my profits, I'll be treated as a permanent establishment or not, and all these. So it helps to bring certainty when it comes to tax treatment to taxpayers in both jurisdictions, based on the Vienna law, Vienna Convention on Law of Treaties, and the fact that this also governs that this is a contract between two states, and that cannot be breached. A breach of it will then result to what I'll talk about in the next few slides coming. So, like I said, basically the tax treatment is for the taxpayers to know that they are not going to be taxed, or they'll be taxed in this manner for the next 10, 20, 30 years, unless and until the treaty is reviewed. But one key point to note is that the tax certainty treatment will go for only parties or taxpayers who are resident in the contracting state, according to the domestic laws and the treaty, but not parties who are not resident in the treaty country. So third state. So one typical example is that if you have an associate in UK and one in Ghana, and there is the parent in, let's say, Barbados, where Ghana has no tax treaty with, and then you say that because the associates and or the branch in UK is resident in UK, and for that matter, you want to go by the UK treaty with Ghana to take benefit, but the ultimate beneficial income is going to Barbados. We are sorry, that income or that benefit cannot be extended to the third state, that is Barbados. And so we will not be able to grant that to that particular. But this is basically to parties who are resident in the contracting state, which is between Ghana and the other state that we have entered into agreement with. So basically, as I further indicated or earlier indicated, in the interpretation or the binding nature of the tax treaty, Vienna Article 26 clearly states that every treaty in force is binding upon the parties to it and must be performed by them in good faith. And this approach ensures that the treaty will override domestic law to the extent of the inconsistency between the tax treaty and the domestic law. If there's no conflict, then of course the two will work hand in hand. But this principle is clearly provided for in our domestic law. If we take Ghana's Revenue Administration Act 915 of 2016, it clearly provides that Section 98, that where there is a conflict between the tax treaty and the domestic law, what is the Income Tax Act. It is the tax treaty, to the extent of the inconsistency, the tax treaty that will prevail. So, for example, if you take the treaty that we have with the other countries, and including the UK, you see that the withholding tax rates that are applicable in there for passive income like dividends, interest, royalties, and also for direct income like fees for technical services, you see that the rates therein either are lower than the treaty rate, are lower than the domestic tax rate, which then means that domestic rate, for example, interest is 8%, but in the treaty, some of them are 6%, 5%, which means that it is the 8% that is going to stand because the treaty has overriding character or effect on our domestic laws. Similar to permanent establishment, which is one of the controversial issues that really happens a lot. The domestic law may provide that within 90 days, if you do construction activity in Ghana, and then over that period, you are formed, a PE is formed, and for that matter, Ghana will have a taxing right over some portion of the profit that is derived from Ghana through that permanent establishment or from the construction activity. But then the tax treaties generally provide for a longer period to which a PE can be formed. So some provide for 120 days, some provide for 183 days, some provide for more than 90 days. So when that threshold has not been met, even though your domestic law provides for a shorter threshold for a PE to be formed, that treaty threshold is what will apply. And I must state that all treaties are not the same. Each treaty between Ghana and the UK, Ghana, Netherlands, Ghana, Belgium, they are all unique and they have their specific provisions. And so in applying those treaties, it's important that both multinationals or even tax consultants, as we are on this call, we look at the terms and the tenet of those treaties and which year those treaties were actually signed and duly executed and became in force and effective. So, and then another point is also about the source rules. As I said, the source rules are clearly also defined in the tax treaties. And then for that matter, all these, knowing these, some few examples as mentioned, taxpayers, multinationals can plan with this for the next 10, 20, 30 years. And none can be degraded. If an auditor comes to a multinational to say that, no, our new income tax act has made this rule, you say sorry because the treaty has not been changed. It's still the rule. So it's basically like a stability clauses in our petroleum agreement, which is basically treaty also provides you that certainty for the next few years until the treaty comes to terminated or reviewed through what you call the protocol. The treaty further provides for, as I've already mentioned, reduced tax rate, lower compliance cost. As I've mentioned, because multinationals, as you know, once you know that the next 10, 20 years, you have you'll be eliminated. I mean, taxes will be eliminated. No double taxation will occasion you. You have access to dispute resolution mechanism. You also know that your rate in relation to investments or passive income investments in Ghana or outside Ghana will be treated accordingly. You can plan with this. And then in compliance, you can also go with it for the next 10 years. And that is where compliance cost becomes quite low for you because you don't have to change your systems. You don't have to do anything much within the next 10 years to be able to meet up with new requirements that domestic laws will be imposing when it comes to, let's say, source rules or changing the rate higher or bringing the rate lower in whichever way you look at it from. But one interesting thing about tax rates and the treaty issue is that, as I said, tax treaties override the domestic law, to of the inconsistency. But now, for example, UK tax treaty, we find out that the rate of taxes in there for the passive income, some of them appear to be much higher than the domestic rate. So interest is 10% in the treaty, but domestic rate is 8%. In this or in that circumstance, or in these circumstances, we apply the domestic rate of 8% when it comes to applying the tax treaty. The basic reason being that the charging provision or the domestic law that imposes the tax rate doesn't have a rate of 10% for interest. And for that matter, the treaty cannot, that rate in the treaty cannot be applied. So it has to defer to domestic rate of 8%. But the reverse is where if the domestic rate was 8 and then the treaty rate was 5, then of course you have given a reduction, the 5% would apply. And that brings me to the point one, as it says that treaty never imposes taxation. That is correct. Taxation is duly imposed by the domestic laws and as approved by Parliament. And basically, as I indicated earlier, the tax treaties basically just assign the taxing rights to the various countries and also sharing those taxing rights as to who tax what. But in all, treaties never puts you or never puts multinationals in a worse position than they would have been in under domestic law. So treaty usually, in fact, mostly all the time, to a large extent, provides a very better condition or state for taxpayers, multinationals, in terms of rate instead of certainty, in terms of thresholds, and in terms of treatment. And the treaty itself has provisions for non-discrimination. And so whereby a taxpayer feels that he or she is being discriminated, not in accordance with the tax treaty, the taxpayer can file a request to the competent authority for us to discuss and look into the issue of whether or not you have been discriminated. But to a large extent, whether non-resident or resident, you'll be accorded and have a very good treatment under the tax treaty. One also benefits to multinationals is the fact that the tax treaty provides for resolution of tax dispute. And this is one key point, irrespective of domestic remedies, which is whether you want to go to court or you want to go to the Independent Tax Appeals Board. The treaty provides that if you think or you believe that the tax authority or Ghana is or is likely to treat you not in accordance with the tenet of the tax treaty, you are at liberty to file what you call mutual agreement procedure request. It is a dispute resolution mechanism that has been provided for within this framework instead of going to arbitration direct. Because normally Ghana, our principle is that tax matters should not go to arbitration or they're not, arbitrable. And so need not to be arbitrated. So the treaties, knowing very well that, of course, dispute is something we cannot avoid. Definitely some of these things, when it comes, you are at liberty to file either with a Ghana Revenue Authority, a designated competent authority, or the other state. So if it is a taxpayer based in the UK or taxpayer based in Ghana, but the issue is borders on Ghana-UK treaty, the taxpayer is given an opportunity to file his or her request within 3 years of the notification of the likely or the actual treatment that he or she or the taxpayer that person thinks that it is not in accordance with the tax treaty. So, for example, royalties. You perform a particular service or there's a subscription Some DTAs don't mention that payment for subscription is actually a royalty. Others say payment for subscriptions, but let's assume that the treaty does not take into account payment in respect of software license constitute a royalty. But then the domestic law provides for so, and which is in our domestic law, Ghana, but a particular treaty doesn't include it. Now, in this instance, tax auditor says that payment for such license constitutes royalty, and for that matter, is subject to a withholding rate of, let's say, 15%. But you feel that that is not what the treaty says, then you are at liberty to file a request to either Ghana or to UK within 3 years of notification. The good thing about this map is that it has no time limitation when it comes to the conclusion of the map case. If we take about 10 years to resolve the issue with the other competent authority, irrespective of the 10 years, statute of limitation does not apply. The remedies or the benefit that ought to have been given to the taxpayer will always be given to the taxpayer after the resolution of the case as well. So that is one of the beauty or the benefits that tax payers or multinationals can enjoy under the tax treaty. Now, this is the process that one have to follow when it comes to. So first, you have to submit the request to a GRA, and then if it's a transfer pricing related, you have to notify the other competent authority that you have filed a map request with GRA, and then once we receive it, GRA will do a preliminary assessment of your request, look at whether or not it meets all the additional all the information that is needed, what are the full details, the facts, the circumstances, the question, the area that has been breached, the section of the treaty that has been breached as well. We'll look at it, and if there are any additional information requirement, we'll send it back to the requester to fulfill it. And then once we satisfy all the conditions, GRA then notifies the other competent authority about it. We engage with them, discuss. The competent authorities are the tax officials who are in the interpretation and application of tax treaties. So they will look at it and see whether or not, based on the fact and the evidence submitted by the taxpayer, the taxpayer's case or he has no case. And once our agreement is reached, the taxpayer is notified about the agreement and whether or not the taxpayer accepts the agreement that has been reached between the two competent authorities, which is why it's called mutual agreement procedure between the two state tax authorities or the other states, whichever institution is in charge of tax matters. And then once that agreement is reached, the taxpayer may or may not accept it. If he accepts it, then becomes binding and final on both state, and then that the decision will be applied accordingly. But I must state that this process can go on irrespective that there's also a domestic process ongoing. So a taxpayer can file both MAP and file court process. It is possible, and where depending on the speed with which either one progresses, the taxpayer can decide to withdraw the court case and say, I want to defer to, or I can halt and say, I'm not interested in the MAP. I want to still proceed to court and get it done. So that is the beauty of MAP and how useful it is to help taxpayer. This slide, I'll just do a quick overview of the articles. Basically, persons covered is Article 1, general typical nature of a treaty. The 2 talks about taxes covered, which is very, very important as well. It is important to know that the treaty covers, or the scope of taxes that is covered. Is it an income tax? Is it a VAT? Treaties generally don't cover VATs and other excise and other taxes. It purely covers income tax. But each treaty actually lists the taxes that they cover and the type of taxes that the treaty will cover. And so, in many a times, we are faced with requests from multinationals saying that some levies are to be included in the treaty. No, the treaty actually, each treaty provides for what exactly the income tax that is supposed to cover. And in Ghana, for example, it is the income tax. And the question is that if a particular levy is not within the scope of the Income Tax Act, then that particular levy, once they have their separate law and is being, even though JRA is administering, it does not come within the scope of the tax treaty. So that is a very, very important thing that taxpayers, multinationals ought to know so that most of the disputes may be reduced as well. Article 3 of most of the treaties will talk about the general definitions of a tax treaty. The definitions of certain commonly used words. But always know that definition as provided for in a tax treaty will always stand over or override the definition as provided for in your domestic law or any other general definition outside the scope of the tax treaty. So we are always careful and make sure that we read the definitions, what has been provided for in the tax treaty. 4 talks about residence. Residence basically is a tax residency, not immigration residency, even though sometimes we use that one as a basis to also check the person's residency to see whether that person has reached the number of 183 days in aggregate within a year to become a resident. So the residency, basically the tax treaty deferred it to the domestic laws of the respective countries and give general principles around what constitutes tax residency, whether the person domicile has a permanent home or he is ordinary resident because he's a citizen and professes a job, or he's being remunerated and paid by the government, or a business resident in Ghana. The treaty, one beautiful thing about the tax treaty is that it has come up with what you call the tiebreaker rules. And it's a rule that is being used to determine where there is a dual residency. So somebody can be dual resident for tax purposes. Resident in Ghana, I'm a citizen of Ghana, working in Ghana, but I've moved to temporarily to go to Nigeria to do some work, or for UK to for let's say 90 days or 183 days in aggregate. Once I've reached that particular threshold, per the UK law, I may be deemed as a resident for tax purposes. So in that instance, the tax treaty have a rule to see how we can, because one country must always tax the income at all cost. So, or you must share the income tax. Okay. So once the residency is dual, then the two states will then come together and determine based on the rule where the person is resident, looking at factors like a home permanently available to the person, where does the center of vital interest of that person resides, as the personal economic interest of the person. We look at the habitual abode, and we look at nationality as a means. When it comes to non entities, we look at incorporation, and then also look at management of the company where they are residing. But this is a rule that is only present in tax treaties. Our domestic laws across don't have these rules. So that is how we use it too. And so before you benefit from a tax treaty, the person must be resident of one or both of the contracting state, either Ghana or UK, or Ghana or Netherlands. If you are not resident in either of these places, you cannot take treaty benefit. Now, Article 5 normally talks about permanent establishment. What is it? Permanent establishment is basically it's a fixed place of business through which the business of an enterprise is wholly or partly carried out in the other contracting state. So a business in Ghana, fully established in Ghana, incorporated in Ghana, and it's carrying on a business across in UK through a fixed place. It can be an office, it can be a warehouse, it can be a shop. Once the activity of that particular enterprise is being carried out partly or wholly through that particular place. So an office can be any office. So as a lawyer, I move into UK, and then I have a small office where I go and do my general consulting constantly, and do my business there, solicit, go to court, and then I come to Ghana. UK can look at it and say that even though my business is resident in Ghana, here, once I've come to UK to perform those services and at a particular fixed location, which is an office, which is available to me, whether high or rented or it's my own accommodation, it matters not. What it matters is that I've come and I've used that fixed place to perform a business of a lawyer over that period. And the income that is attributable to me, or the income that I've earned from that activity in UK, is taxable in the UK in my hands. Ordinarily, no country can stretch her taxing right into the territory of the other country. You can only tax my business income or profit only when I establish a PE or have a PE through which I carry out my activity. So that is the principle of permanent establishment. But then further to this, we have what we call construction PEs. So FPSO construction or the airport construction, the companies that came from, let's say, if they are UK-based companies, for example, they came to construct the airport. Once they spend 6 months for the construction of the airport, the income that is paid to them or the business profit that is paid to them, that portion of income will be taxed at a rate of what? Either 25% or 35%, depending on the industry, instead of using the withholding mechanism to tax that income in the hands of that. We have what you call services and exploration or exploitation activity. In Ghana, for example, if you come to because of our natural resources issues, mining, petroleum sector, if you can perform services within that space, those services can be deemed as having created a PE, and the income of the non-resident person can be taxed in Ghana. The portion of the income that is earned from here. Likewise, when you go into exploration or exploitation activity, that would it's actually a novel. Let me say, I won't say novel, but it's something that Ghana has pushed, and it is has been adopted within the UN model tax framework. And within this framework, what it means is that unlike the normal construction, this is a specialized area. You are extracting our natural resources, and so whatever period, once you are extracting or exploiting natural resources, whether seabed on the land or um, the, um, the shallow waters, wherever it is, you would deem to have created a PE. There are a number of activities that may also may not qualify as a PE. We have if you just use a place for normal delivery or as a preparatory and auxiliary activity. So you create an office for a company to set up in Ghana. And that activity, that office here, primarily is just to conduct research and to just do preparatory grounds for the company coming from UK to come and establish. In that circumstances, that activity of preparatory or the auxiliary nature research cannot be deemed to be the activity of, let's say, the insurance company coming to establish in Ghana here. So for that matter, we say that PE cannot be. If it is a normal warehousing activity that you're also performing, where you just stock goods and then just stock the goods for preparatory or just trying to stock goods for on behalf of other people and then delivering to them normally. Some of the treaties will say when you do delivery, it doesn't constitute PE. Others say when you add delivery to it, you store and then you deliver, it becomes a PE. So again, like I said, it depends on each treaty and how it's been drafted. Insurances, when you perform or you insure a risk located or situated in Ghana, once you constantly perform or you insure risk and collect premiums, the treaty generally says that that activity constitutes that you have formed a PE, and for that matter, those income that is attributed to you will not be subject to withholding tax, but rather subject to a full business income taxation, subject to the various deductions that is available to any normal business, whether in the field of insurance, if it is 22% taxation, that is what will be taxed accordingly. But that is to say that it's basically this rule applies when it comes to dependent agency. If it's an independent agency activity, that is, you have an agent who is just doing general brokerage or doing general insurance for all companies across the globe. Then, in that nature, that independent agent, insurance agent, cannot be deemed to be the PE of the non-resident persons, but it's only in relation to dependent agents who conclude contracts and other things for and on behalf of insurance companies, and not just insurance companies, but also for any other business or other field. So if there is a dependent agent for, let's say, banking field, and then all what they do is to do banking activity for a particular bank located in the UK, that dependent agent will be deemed to have a parent established or have created a PE for the banking business in the UK, provided that that dependent agent activity leads to conclusion of contracts, and the contract only just go through without any material modification by the principal. The principal just execute those contracts. So that is, in a nutshell, PE rules that we apply. Generally, what we say is that the fact that a company has an associate company in Ghana does not in itself connote that the associate company is a PE. It's only where the associate company is found to have been conducting the activities of the non-resident or the parent solely and purposely, and then making money to them. Then in that circumstance, the associate will be deemed to have created a PE for the parent. But ordinarily, associate enterprise of a non-resident person does not itself constitute a permanent establishment. Only where the associate is used as a means for conducting the business of the non-resident, that is where that associate enterprise will be deemed to have created a PE. Article 628 basically talks about income from immovable property, not generally land, buildings, and properties located in Ghana. We use what we call the lex situs principle, which is that the taxation right usually is to the country where the property is situated. And so if you sell a property in Ghana, it is Ghana that will have the taxing right over the capital gains thereof. Or yes, business profit, like I said, is basically taxed by the country where the business is located or resident. It is only taxable, or that particular profit is taxable in Ghana where that particular income or that particular enterprise carries on business in Ghana through a PE. Then 8 talks about international shipping and air transport. 9, transfer pricing rules. Then we have the dividends, the passive income articles, which basically talks about how dividends will be taxed, interest will be taxed, how royalties will be taxed, and fees for technical service will be taxed. But with these 3 or 4 articles, normally the test is that it's not just that the resident person, you are resident only in the contracting state, and for that matter, you are to receive the treaty benefit of the reduced rate. We will go a step further to check whether or not who is the beneficial owner of the income when it comes to dividends, interest, and royalties. Is the income going to the hands of that resident person alone, or it is just a pass-through? So the company is a branch in, let's say, UK, but the parent is in Cote d'Ivoire. Ghana and Cote d'Ivoire has no treaty, and then they use the branch to perform the royalty activities, or sorry, to receive the royalties. for the benefit of the Cote d'Ivoire company. In that instances, the treaty says that you cannot benefit from the tax treaty, and so we will deny you the benefits thereof. Same principle applies to both all the four I've mentioned: dividend, interest, royalties, and fees for technical services. Capital gains, basically, as I said, talks about taxing the capital gains as and when they come up, and then independent personal services, also Article 14. Employment, dependent personal service, directors' fee, and top-level officials, entertainment and sports persons. These are just to give you the various articles that the tax treaty contains. And we have pension, social securities, and then government services. But if it's a government service and it's in the nature of a business, that is usually excluded because it's purely government to government. If it's a government to government activity, which is wholly government services, then of course the DTA exempts it from being taxed by the other state. We have student, professors, teachers, and then we have who is entitled to benefit. We look at, again, form over substance, substance over form, and we look at the fact and evidence to be sure that people are not coming to take treaty benefits where they are not due, they are not resident, or they are not beneficial owners, or they are just a shell company through which activities are being performed. And for that matter, we have to rely on the limitation of benefit clauses within the DTA and also the long title, as I mentioned earlier, to deny you the benefit. As I mentioned earlier, double taxation agreement, it has the provisions for eliminating double taxation. So we have the exemption method and credit method. And as I indicated, Ghana uses the credit method as under section 111, section 112, and some form of exemption method when it comes to employment income in relation to non-resident employer for an employee in Ghana. These are other sessions that I spoke about: non-discrimination, the MAP, exchange of information, assistance in collection of taxes, and taxation of the diplomatic missions and consular posts. Then the final provisions will have entry into force, date of entry, and the date of effect. That is quite important, that almost the DTA, when the date that it comes into force, it's not the same date that the DTA takes effect. The DTA can take effect the next year normally. If the DTA is entered into force, let's say 2026, the date of effect normally is the next year, the 1st January of the next year, because there could have been, just to allow for other transactions that have already taken place to be settled before the DTA will start applying. And then termination of the convention, and then the protocols are there, which are very key and form part of the tax treaty. But normally, sometimes we forget to look at it. And the protocols serve as an amendment, clarifications, deviations, or updates to the existing tax treaties. And so some of the provisions might have changed because of renegotiations or some form of agreement that the two states have already reached. And you will not find it easily. So when you go on our website, for example, all the protocols attached to each treaty have been uploaded for the benefit of all. This is it. These are the 4 countries that we have treaties with them: Belgium, Czech Republic, Denmark, France, Germany, Italy, Mauritius, Morocco, Netherlands, 14. And as Christiana said, we have 36 that we have initiated, and they are all at the various stages of the process. And you can find the information on our GR website accordingly. These are the applicable treaty rate. Of course, all this information can be found on the GRA website. But in particular, let me give this quickly. If you look at the treaty with the United Kingdom, for example, interest is 12.5%, royalty is 12.5%, but our domestic rate for interest is 8%. So in that instance, it's the 8% rate that is going to be applicable accordingly. Yes. How do you apply for treaty benefits? A simple application letter, or we can send an email to our email that will be provided at the end of this section. stating the facts why you want to apply, which section of the treaty provision that you are relying on to come, provide your TIN, give all the evidence, tax residence certificate that you have to provide. You attach it from your treaty country, corporate registration documentation, the directors, company profile, beneficial ownership details. You attach all contract agreements that are pertinent to the transaction that you're applying, tax compliance evidence, TCC and all that. I mean, we have put out the entire process as a practice note on the GR website, which you can find. So that is how, but we are going digitized very soon. We'll have this whole process fully automated for taxpayers and also multinationals, both in country and out country, to apply for treaty benefit to our GR offices, and we can handle it accordingly. Major challenge with this is that mostly people don't give us the details with respect to contracts, the beneficial ownership issues. They always forget to include certain withholding receipts or payments that have been made and all that. And it drags the process of granting the application, because we expect that all this information will be provided to us for us to do a full evaluation. It's not automatic that once there's a DTA, automatically you should be able to take benefits. No, we should apply and get approval from GRA accordingly. Quickly, international tax cooperation frameworks. We have the ECOWAS Supplementary Act. We have also signed on to the Multilateral Competent Authority Agreement, which is on common reporting standards, and also we are yet to implement the CBCR to receive account information. We are also signatory to the Convention on Mutual Assistance in Tax Matters, which we use as a framework to exchange information, or we also rely on the existing double tax treaty agreement to exchange information. I think Mr. Noe, policy man, will touch on other things with regards to human matters that are currently ongoing. I hope I've not run too fast. If I did, forgive me, because my time was running so fast, and I guess this is where I draw down the curtains, and I'll pause here and yield the floor back to Christiana to proceed. Thank you very much for your attention. This is our email. This is where recently we received all tax treaty benefit applications that are coming in thereof. Thank you, and have a good morning once again.
Thank you so much, Mr. Nana Mensah Otu Esquire. This is truly informative. Really appreciate. Before I know we have quite a number of follow-up questions with this great submission, but I'll invite Mr. Noah to give his update before we go into the conversations. Mr. Noah, please, you have the floor.
Good morning again. And as Nana indicated earlier, we have had quite a number of agreements over the period. There's been bilateral agreements, there's been multilateral agreements, and quite a number of them. Now, in 2024 and 2024, the United Nations passed a resolution. That's United Nations Resolution 79/235 on the promotion of inclusion and effective international tax cooperation at the United Nations. And that resolution formed an intergovernmental negotiating committee, and with terms of reference for developing a framework convention on international tax cooperation, and also 2 simultaneous protocols on specific subject areas. Now, this committee basically was asked to complete its work and submit the final text of the convention and of the 2 early protocols to the General Assembly for consideration in the first quarter of the 82nd session in 2027. And now, as a UN session normally is 1 year, it starts from September of 1 year, ends in August of the next year. So the 82nd session will start in September 2027 and end in August 2028. So between September and December, the Framework Convention must be submitted to the General Assembly for them to discuss and then give a ruling on it. Now, the Framework Convention, basically, the idea is to establish an international tax system that is what we say is transparent, inclusive, equitable, fair, and effective. And the idea is that currently we have a number of treaties based on either regional level or country level. But there was a need for something which would have worldwide acceptance and implementation so that everybody basically would have. Currently, we have a OECD. When it comes to double taxation, we have the OECD model, we have the UN model, we have an ATAF model, and so many other things. The idea is to bring something which can be a bit more uniform, bring rules that are uniform and cut across everybody. The other thing is also to at least provide some level of flexibility and resilience to the international tax system, and then also facilitate sustainable development. Now, the idea that has come with this has become more important because previously, basically, as Nana mentioned, a lot of the things that were done, we are dealing or trading, we have the normal brick and mortar, the permanent establishment is a place you can see. Now, with the growth of services and digitalization, there are a lot more things that are done cross-border, which previously would have had to go to a country to go and do. You don't. And so with these ones, the rules continue to change. The issue of double taxation is becoming more and more serious. And there's the need to provide some certainty and in terms of what is done, or should I use the word uniformity in what is done. So that is why this is being looked at. And so it's expected that when we complete the work, there will be some changes to the way some of the things are done. There will be additional things that will be required of us as states and also as the taxpayers who are the ones who pay the taxes. Let's note that the double taxation agreement basically is to the benefit of both the state and the taxpayer. The taxpayer, so that it doesn't get taxed twice, and or at least if it's taxed twice, it doesn't pay high amounts in each state, and two, for the states also to be able to get their share of the revenue that is generated from their country. So that is generally what is happening with this. I was trying to put this, maybe I was going to put a website where we can get more information on it. I'll put the website in the chat box so that at least we can pick it from there and follow it. Thank you.
Thank you very much, Mr. Noah. I will invite Mr. Dauda Hafizdin Esquire. Given your experience with working with clients, can you share some of the challenges, practical challenges that they face when it comes to assessing the treaty benefits under the double tax agreements?
Okay, thank you very much, Christina. And then to my co-panelists and then the participants, good morning to everybody. I think as a practitioner, usually advising clients on tax planning, legal opinions on tax matters, or structuring of business and all that, you get to realize that even though there are double taxation agreements, the multinational businesses usually do not have clarity in some areas, and for that matter, try to structure their operations, activities, or transactions in such a way that will either minimize or avoid them being taxed twice, even though they may be taxed a double taxation agreement. So you get a lot of those issues. And as Nana Mensah was speaking, he mentioned permanent establishment as one of the areas that we have a lot of controversy. Day in, day out, you get a lot of requests for how maybe you, as a practitioner, how you think this particular transaction will be characterized. Will it probably consider as a permanent establishment, or would it even be subject to taxation at all within the jurisdiction? There may be a number of things that may account for that. I think one of them is probably how the different contracting states or the different entities may interpret what a particular transaction stands for. One of the areas within the permanent establishment we realize is when it comes to engineering, supply and installation contracts. We get that quite often, where maybe an entity is probably supposed to supply an equipment and also install the same equipment. Now, what you see most of them doing is that they want to have the contract for supply separated from the contract for installation, and sometimes probably they have service contracts, to provide some service over a period of time. Now, when you look at our laws, within the definition of what may constitute a permanent establishment, installation contract that lasts for a certain number of period, I think 90 days, may be considered as a permanent establishment. However, you go back to the Companies Act, it requires that if you establish a place of business in Ghana, within 30 days, you have to register with the Register of Companies. In that case, you go and register as an external company. And within the meaning of having been registered, sometimes you start to get requests for payment of taxes, register for installment payments and all that. Within that period, you might not probably have met the threshold for permanent establishment. But having registered, there are obligations that you will have to perform with the tax authorities. So clarification on some of these issues, especially when it comes to this engineering procurement contract, I think it has to be an expansion of the definition beyond just the number of days that would probably constitute a permanent establishment, to sometimes decouple the supply from the installation. Because I think that if an equipment is just supplied from a contracting state, there could be a situation where the supplier is not the one supposed to do the installation. In that case, you don't have the supplier to tax at all. However, if the supplier is supposed to install, then the tax authorities sometimes may want to bundle the transaction of both the supply and the installation as one contract, and then subject the entity to determination as a permanent establishment, and for that matter, an income tax issues may arise. So that's one of the issue. Then the other one is we keep also getting is administrative procedures of getting the benefit of double taxation agreements. When Dr. Nana was presenting, he listed the requirements, and some of the requirements I think we probably could. For example, you're asking for withholding tax certificates, you're asking for tax clearance certificate. I know it might not apply in all cases, but what we experience practically on the ground is that once you go to make this application, some of these things are asked for and then they delay the process. Even when you say you are a new company, you haven't even properly started operations, you haven't even properly, become a permanent establishment as you, but you probably envisage that by the way you are going, maybe you may just become a permanent establishment by the count of the days that may be provided under the DTA. One issue also is usually when it comes to the mutual agreement procedures on the determination, it would be very good and also help the process if some timelines are determined. From the presentation of Nana, he also highlighted the fact that it can go on for quite some time, the determination period. DTA is supposed to provide some certainty. Now, if I have a dispute over a critical transaction or component of a business that probably will have to inform whether I can still make some good return from this business, I may have to continue operations, and it takes about 5 years to be resolved, then the certainty that DTAs are supposed to provide will probably not inure to the investors. So I think that at least some level of timelines that probably should be assured to the investors or to the companies that probably ignite mutual agreement procedures would probably have to be outlined, in some of the DTAs, in my opinion, because that will actually promote a lot of investment. Because if the person is not certain, or the business is not certain that my transaction will probably be classified as falling under a particular income definition that might give me a lower tax rate, then you might see that the investment probably may be put on hold until some of these determinations are done before. Because once it takes 5 years and it is determined unfavorably against the multinational business, then it means that you have to probably go back and then compute the necessary tax that may be applicable for all that period. It may have a lot of implications for return that the business would have made from their investment in maybe in Ghana, for example. So the issues of interpretation of what also constitutes the characterization of an income or a transaction. Nana explained something on maybe third-party businesses. So that's also another area that a lot of the multinationals have challenges with. You see, while we're looking at beneficial ownership, however, we also recognize the fact that there are separate legal entities. Let's say within the African jurisdiction, let's say we have a company in South Africa as a headquarters for African region, also having some investment from even South Africans. It might not probably meet 50%, it might be 20% of South African investing in it, but it has an ultimate parent maybe in a non-DTA country. In instances like that, we probably may deny them the treaty benefit in South Africa because there is also an ultimate beneficiary that takes a certain portion of income ultimately. And sometimes, I mean, it's not only just the income that also determines the payment of the taxation, but probably maybe within the profitability of the business. But we are making a certain bulk payment of income that probably might be used as part of the chargeable income in the other contracting states. So I think we probably would also have to expand and probably give some leeway for businesses that might have subsidiaries across various countries that might also be headquartered in other jurisdictions with double taxation agreements and all that, so that they can also enjoy some of this treaty benefit. I don't subscribe to treaty shopping. However, it is real that businesses definitely have to invest in areas that they can make return. So they will continue to search for countries where they can operate and still maximize some returns for the shareholders. I think so. Practically, these are some of the issues day in, day out you may encounter or we get when we have issues of advisory opinions and double taxation. So I think the last one is transfer pricing.
Oh, maybe Nana, sorry, maybe Dauda, if you can pause here so that because I can see that the challenges are really, really practical and really real. I don't know, Nana or Mr. Noah, who would like to take this? I think it's about 4 of that.
Nana can go ahead. Nana, go ahead.
Okay. Thank you very much, Council, for that detailed perspective and from the industry. So basically, with reference to, let me start with the issues of PE and miscontract issues that you raised. Basically, they ought to, as you rightly aware, those contracts will actually be separated, right? Unless they are incidental to the supply of the equipment. But if they are charging them separately, we always expect that contract has to be split, and then we'll look at it of the activities in that sense, and then the income thereof will have to be looked at it, whether to tax it as a supply of goods or as we are taxing it under as a service or and all that. So of course, we appreciate the challenges that you are facing, and also as GRA, definitely we also have that challenge of when this contract are lumped up, it becomes quite also difficult because then you don't know how these monies are going to be distributed. So it's always good that as an advisory to the businesses, we expect that the the contract is actually split, unless, like I said, they are incidental to the supply of the goods. Then, of course, but if it's not incidental and they are performed by separate entities, for example, installation is done by a separate entity, then of course we look at, like I said, a particular DTA. If it's coming under a particular DTA, let's look at what are the provisions that the DTA has provided for, and then we would then apply to see whether or not those circumstances have met the threshold or they have not met the threshold. In fact, I can say that most of our DTAs don't have supervisory activities in connection. I mean, we don't have those things. It's only in connection with construction that supervisory activities can be deemed to be a P. But when it comes to other supply or other contract, we don't add furnishing of services. We always take it out of scope within the meaning of a P. So maybe, but we'll expand on it. We appreciate that challenge. We'll look at more details to expand on that and then give some guidelines on how these things will be treated. Secondly, with respect to external company registration vis-a-vis P threshold, it's again, I would say that it's interesting. But then the point is, like I said, what does the DTA says? What does the DTA says? Has a P been established in accordance with the very relevant article? So that is where always the question. So the question is always that look at the DTA itself. I think multinationals advising them, what does the DTA says? Yes, company law requires that 30 days come and incorporate. And I made one classical example to say that the fact that you are an associate company registered in Ghana here does not necessarily mean that you are a P. You only become a P when within the meaning and the scope of the DTA, it provides that the activities of the non-resident contracting state, the non-resident taxpayer, is being carried on through, whether wholly or partially. And so it's a matter of fact and evidence that we have to look at it. But a mere incorporation at the register of company does not in itself constitute a P or surrogate. The P will only become in when the activities of the non-resident. So you can even incorporate, and if the activities of the non-resident is not being carried on wholly or partially through that particular external company, P cannot be formed, and for that matter, P cannot be taxed, which is why Mr. Noah is saying that, as we are saying, we are shifting even from the concept of the physical presence matters and now moving into significant economic presence and also looking at taxation of services, irrespective of whether you physically perform the service in Ghana or you perform the service abroad. So far as income is generated or sourced, or there is some economic presence having attributed to. So, council, basically, that is what it is. With respect to documentation for DTA benefit, yes, I agree with you. Not all the situation will apply. But technically speaking, most jurisdictions or some jurisdictions don't even grant PE on future activities. DTA benefits are usually granted to when activities has been, concluded for us to then confirm. So issues of beneficial owners and all that to see whether the income that was sourced and paid to the resident entity actually went into the beneficial owner who is also resident in the contracting state. But we are managing, because we are investment pro, we are doing the two side by side. Sometimes we're looking at the contract yet to be, or they are about to execute a contract, and then we grant. So that is where the two parties, we are in that state, and we are also minded that we don't want to just give out anything because we should just grant the approval to people to just take it. But like I said, it's the beneficial ownership requirement only comes in when it has to do with passive income and then issues of technical services. The rest, we don't look at issues of beneficial owners. And the beneficial ownership issue here, we are not even looking at the ultimate beneficial ownership as defined under BO, but we are looking at whether or not the resident person that is in, let's say, the UK, actually the one that is receiving the income, and then they have absolute control and ownership of that income without subjecting the income or themselves to the direction and the wishes and control of another person outside the treaty country. So I'm in UK, I receive income. I say I'm resident in income, but then I'm being directed by my another person in Barbados to direct and use the income for a particular activity, which means that I'm not the owner of the income. So, which is why but of course, these requirements are so subject to review, and then from time to time, based on your business needs as you are bringing, we will also look at it, review them to ensure that both, as Mr. Noel reiterated, the revenue is not lost, and then you are also not unduly disadvantaged. Um, I don't know whether I've been able to touch on all the issues, but basically, I think the map timelines. Lastly, it is a very good point. The only thing is that we have intended to put timelines to it, but then sometimes we are dealing with the other contracting state, and so we are not able to really force them. One that we are dealing with since last year, we tried to have a meeting with the other control authority for almost a whole year. We couldn't meet them, and we have now been able to reach an agreement to meet them next week Friday. So you can imagine a whole of 12 months of 2024, there was no meeting because they were overly booked. And so where we put timelines to it, and we are unable to meet them, that's the reason why mostly map, but per the BEPS actions, and there's a timeline that at least within, if you look at my slides, we have some maximum 36 months within which we should try as much as possible to conclude, but some can really prolong. All right. So I guess, Christiana, I can pause here for others to come in. Thank you.
Yes. Thank you, Nana. We have a couple of questions in our Q&A. I would like to read them out, and maybe between you and Mr. Noah, you can respond to that. So the first question says, thank you for the session. Could you kindly confirm the current status of the ECOWAS Treaty as it pertains to Ghana?
Okay, so this one quickly, myself and Mr. Noah, it falls within our scope. So, yes, President have signed the treaty, but it's not yet ratified by Parliament. It's going through the process, and I'm sure within this year, we are hopeful that this treaty will surely come to effect, because we've done all the necessary background works. I think Mr. Noah can confirm that we have put it through. The issue, the tricky part of this treaty is that, the ECOWAS treaty says that this is a supplementary act, which should be like an addendum to, like an additional, an amendment to, or an additional protocol to the ECOWAS treaty. But then it has taxing provisions, which has varied the tax rate. And so we initially, ECOWAS Parliament, or sorry, ECOWAS Commission were of the view that it should have automatic effect. But we said no, per the Constitution of the Republic, it's only Parliament that has the powers to what? Vary tax, impose tax and all that. And so even though President it's been signed by heads of state, we need to at least take it to parliamentary for a simple resolution for them to come to effect. So we are hopeful this year will come to. Thank you.
We'll keep our hope alive. Okay, so the next question from Eugenia says, how long does it take for the GRA to grant an entity a DTA benefit after submitting all relevant supporting documents? Also, is there any applicable fee?
Okay, this one is GRA issue. So straightforward with the last question, there's no applicable fee. So there's no fee attached to it. With regards to timelines, we do confirmation of the documentation that is submitted to us with our treaty partners. So if you are coming under Ghana UK treaty, for example, and we have brought in tax residence certificates and all that, we need to confirm and validate that indeed those certificates were duly issued from the UK. We've had instances where within a week we've had confirmations. Some countries have done automations where we can validate. So, for example, Belgium and Morocco and Mauritius, for example, we can validate those tax residence certificates through a portal that they have given to us. So once you bring it to us and we validate it through that portal, within a week, you should have your response from Ghana Revenue Authority. The delays usually comes from the confirmation of the residence certificates and other information that we require from the treaty partners, which sometimes delays quite substantially. But even with these delays, what we try to do sometimes is that we grant temporary approval to them, subject to confirmation. And where confirmations are done and we find anything contrary to what has been presented, we then can come after the taxpayer for false information and collect all taxes due. So per our timelines, we have maximum 1 month. No, sorry, it's 2 months. Sorry, we said 2 months. Sorry, 2 months. It's 2 months. But again, subject to within 2 months, we will be able to approve. That is subject to the confirmation that we receive from the the treaty partner. Thank you.
Okay, so as a follow-up question, do you not think that these guidelines could be seen as a measure to make the process cumbersome, such that taxpayers will choose not to assess this treaty benefits?
Christiana, can you I'm not getting what do you mean by
Yeah, so the question is that looking at how long it takes for the approval to come through, do you not think it's more of going to be a measure that will make it difficult for genuine taxpayers who actually can assess this treaty benefit choose not to do so?
Well, I would say it's a barrier. I would say rather it's really giving them transparent to know that this is the process. Because I think for years back, we didn't have any guideline, any procedure, any process. And of course, people were taking advantage of the treaty benefits without even requesting for approval. And our data from the system showed that, or has shown that, when we did an audit of the system, we realized people have taken advantage and they are not actually treaty, they are not in treaty, they are not resident in tax treaty states. Huge sums of money is gone. And so we see that it's a win-win situation for both parties. It's a good starting point for the two, both the taxpayer and the GRA. And like I said, we are now automating. In fact, one of the delays also comes from the paper processes, where it has to go through sometime through the taxpayer service center, or it goes through the commissioner general's office before it comes to the international tax office for processing. But with the, like I said, I'm sure by end of this year or less, we will have a fully rolled out automated process where taxpayers, so automatically everything hits our system and we can do that quick validations with checking the boxes to make sure that we meet the time, and the timelines will come down. So Christian, I think that is our answer from GRA. I think that it is a win-win for us, and let's all help the system work better. Thank you.
We look forward to that short timeline. A question here says, considering the level of economic integration within ECOWAS, why are there still no double taxation agreements between Ghana and some neighboring countries such as Togo, Benin, and Cote d'Ivoire? Because even going through the 36 that you have, I think it's only Nigeria and Egypt, which are all in the initial stages. Why don't we have with our neighboring countries and other African countries?
Okay. Thank you once again for this question. In fact, almost the other 15 or 14 ECOWAS member states approached Ghana to initiate, but that is where the ECOWAS Commission initiated the ECOWAS Supplementary Act on Double Tax Treaty, and so which includes the French-speaking countries and then the one Portuguese state, and all of them were part of the negotiation process of that particular treaty. And so I think Nigeria had already started the engagement with us. So we actually fast-tracked the Nigeria. The Nigeria treaty has been concluded is left with signing, but they are also even looking at for the ECOWAS treaty to come into effect, because the terms or the conditions in the ECOWAS treaty are more favorable and more, also protect the taxing base of both all the contracting states. So we are hoping that once we get this ECOWAS treaty in force, which means that all the ECOWAS member states will have a treaty with them accordingly. Yeah, thank you. And I must say that this treaty is in force in all the French-speaking countries in the ECOWAS region, and then now Liberia has also brought it into force, and then I think Gambia also is in process. Nigeria too has also brought it into effect. So it's left with few English-speaking countries that are going through the process. Thank you.
Okay. Then, so what are your thoughts around permanent establishment for digital services providers outside the shores of Ghana to Ghanaian customers?
Okay. Quickly, I think Ms. Anwar touched on it. Parent establishment requires physical presence. That is what it is, right? To establish a PE, what it means is that you have to be in country or in person within to work or through an activity of an office of that sort. But then with a new system, what we call significant economic presence test, and also with the service, taxation of service, we are doing away with PE. And so the digital service tax is what is coming to more or less replace or to enforce or to reaffirm the taxing right of source countries. So Ghana very soon is actually amending our income taxes to introduce digital service tax, or sorry, digital asset taxation, and also introduce what we call significant economic presence test to tax, so that remote service workers and all that can be taxed accordingly. So that is how we are, because if you say you want to follow the traditional PE concept, you're not able to tax any of these remote services whatsoever. And then I must end that the UN, even at current level, has changed the way services are taxed entirely. We have both the automated digital service tax and also the service across generally how it is also taxed. And Ghana is going the same direction. Thank you.
Well noted. Um, some of Ghana's DTAs, I want to believe the anonymous attendee want to say are outdated. Any plans to update these to align with the latest model conventions, either UN or OECD?
Maybe Ms. Anwar, I will leave that to policy, Ms. Anwar, to tackle for
Policy.
us.
Mr. Noah,
Yeah, Christiana, I said, can you read
yes.
all the questions there so we tackle them together? Yeah, instead of
Okay,
separate.
so some of the Ghana's DTAs are outdated. Any plans to update these to align with the latest model conventions? Then we have, which interpretation style does the GRA adopt in applying provisions of the DTA? Is it static or is it ambulatory?
Yeah.
Then, what is the GRA's position on the relevance or importance of the commentaries? Are these persuasive or binding? What is maybe I'll take this last one and then we can. What is the
Yes.
GRA's legal basis for requiring prior approval for treaty benefit utilization?
Okay. All right. So I'll begin and then Nanel can continue.
Okay.
For the first one, we agree that some of our DTAs are dated. And so there are discussions to sort some of these things out. What sort of put us on hold are the current discussions going on at the UN? Because when we finish, by all means, there'll be some changes to what we are going to do. So it's likely we would prefer to finish that one instead of working on them twice. Align with the latest model conventions. In fact, when we are talking model conventions, please, when you are talking Ghana, don't bring in OECD. We deal with the UN model convention, the ETAF and the ECOWAS ones. We don't deal with OECD. I mean, that's the truth. So yes, we are plans to align and do all these things that we've been discussing. We've been involved in those discussions to update the model convention for the UN. And so that is it. Now, and the importance of commentaries and whether they are persuasive or binding. Commentaries are persuasive, they are not binding. They explain what the reasoning is behind it, and then you decide what to apply and what you don't want to apply. They don't bind in any particular session. They're just explanatory. The legal basis for requiring prior approval for treaty benefit utilization. For everything, there's a process. When you put in a law, you have to put in a process. The process is that you need to confirm that the person should benefit from the treaty. So you can't just get up and say, and I think Nana gave an example where people were giving treaty benefits to entities that did not, should I say, did not qualify for those things. So I think we need to take that one into consideration. I'll leave the interpretation to Nana because that's GRA related. And while I'm on it, Christiana, if I may, there are a few more questions that relate to the OECD process. Can I add them to what I'm talking about now so that we save time?
Yes, please.
Okay. So the other questions that relate to OECD related items is some of them. I want to ask about the OECD Pillar 1 in relation to multinational companies. I want to ask about the OECD Pillar 1 in relation to multinational companies whose products are traded in Ghana without PE. And then there was another. Has Ghana adopted the OECD guidelines? Seems nothing was mentioned of it, only the UN manual. As I mentioned, we use the UN model. And so basically, it's the UN manual we use when we are looking at the guidelines. In terms of Pillar 1, we are not members of the inclusive framework. We have not joined the Pillar 1. So really, our domestic laws and our current treaties apply to everything we do. So we don't look at Pillar 1 in doing anything that we have to do. We just apply our normal domestic law and the treaties. I think that takes care of those items that relate to it. Maybe Nana can talk about the static and ambulatory interpretation, and then you can go on with the questions.
Okay, so Nana, as you talk about that, please add during an audit where a company did not apply for payments that they have made to a supplier who is in the treaty country, what measures are open to such a company when the GRA auditors raise an issue in terms of withholding taxes?
Okay. All right. Thank you very much, Christian and Philip and Ms. Anwar for that detailed explanation. So basically, let me start with a quick one on the issue of interpretation. Like I said, each treaty is unique, and it was negotiated based on certain terms and principles as at the time it was negotiated. There are two schools of thought, and I'll give you the two. One believes that if you are interpreting a tax treaty, let's say Ghana UK treaty signed in 1990, 97 or 98, I've forgotten the year, in the 90s, for example, which of the treaty models are you going to use to interpret? The school of thought is that one says that stick to, in fact, there are case laws which state that we have to, because we have to follow the model at the time that the treaty was negotiated, because it's an agreement that was signed between the two states based on the principle that existed at the time. And another school of thought is saying that no, use the current model tax convention so far as it is relevant and useful to that particular treaty. Ghana's position, we have always used to use the ambulatory nature, but then we're challenged by some taxpayers, not in court per se, but challenged by taxpayers through their competent authority, that they which also believe that we have to use the static approach, which is the time the treaty was signed, because that is the the principle under which underpin that particular treaty. But my personal view is always that I believe that the treaty as it is, the agreement, is neither the UN or the OECD, because the two countries, for example, we are with OECD country like with UK, which is OECD country, their model is aligned to OECD. Ghana's model is aligned to UN. The two parties sit on the negotiation table. We give and take, and then we come to a particular agreement. There are notes that we take during negotiations. There are note letters that we write, which we give explanations and guidelines. And mostly that is what some of us, we, in fact, in applying the treaty, we use in trying to explain, because some of the provisions may not necessarily be in either of these models. So, for example, Ghana's treaty, all treaties, you have under the interest article an exemption for government paying. Anytime there's a government paying for any interest, it's exempt. You don't find it in any of the model text, but that is Ghana's because of our unique nature. Okay, so in the interpretation, it's basically a mix of the two, but primarily we have to look at the tax treaty in the context of the the principle as at the time it was actually negotiated. Because if you try to bring in the new model text explanatory notes, it may not really fit for purpose. That is all. So the second issue that you raised with audit, where the taxpayer did not seek or did not sought for approval before. The auditors may be largely right, may disregard and then apply the rate, because the rule is that, as we said, um, the, the 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 taxpayer may not necessarily be resident. Alternatively, we also sometimes advise the tax auditors to then leave this issue and then refer the matter to us for us to go and do validation and confirmation to see whether or not the taxpayer was actually supposed to have benefited from it. And where we find out that it is not, or the taxpayer was not, as at the time of applying for the treaty, not resident and or beneficial owner of that income, then we can go back to the tax payer and apply the sanctions thereof. Thank you.
Okay, that's well noted. Let me read a couple. I'm very mindful of our time.
Yes,
Um,
yes.
so there's a question which says, why haven't we signed one with the US? Then two, with the confirmation process, does that mean that when making a payment to a UK partner, I must wait and apply to GRA before I can determine the withholding tax rate to that UK partner? Then there is, how should withholding taxes be filed for companies resident in countries with which Ghana has a double taxation agreement, considering that the GRA's withholding tax schedule does not reflect the applicable DTA rates?
Okay. So with a quick one, the whether to wait. So the ground rule is that you apply the domestic rate and then you apply for um, the um, the benefit thereof. You are supposed to, like I said, in a proper organizations or proper other states, other places, the transaction is carried out, domestic rate is applied, and then we examine the issue where the person qualifies for treaty benefit. A refund is given or a credit is given. But then we have put the two in place. So we said, okay, apply for it. Let's do a quick validation to check that the person qualifies for it. If indeed it qualifies for it, we will grant you. This process doesn't really take so much time. Honestly speaking, like I said, we grant temporal approvals to a lot of multinationals awaiting confirmation, because you realize that the confirmations were really taking so much time. And so we grant temporal approval. It's only where we may deny you where we realize that based on the fact and evidence given to us, we suspect treaty shopping arrangement or you're trying to go around the system, then we may deny you and ask you to file for use the domestic rate, and then apply the treaty rate where we find how do you call it? We receive a proper confirmation thereof. I think you mentioned something with regards to there was a question that followed up.
US, let me take that question.
Okay, go ahead. Stan.
Okay, so generally for a DTA, there must be some expression of interest from both parties. One side will meet up with the other and the other will raise it. Now, in the case of the US, none of us have really come up with that request. The US hasn't made that request. We also haven't made that request. And the US system is a bit different from some others. So sometimes they have the ways they look at some of these things. So the answer is that none of us have approached it either for a DTA, which is why we don't have one. And there are other, as I said, there's the foreign tax credit system, which can be used anyway. So some countries prefer to just use the foreign tax credit system instead of having the DTAs. There's another part of that question, which asks why sometimes you can have higher rates in the domestic law, in the treaty, than in the domestic law. In the case of the UK, for example, at the time we had the treaty, the tax rate was, I think, around 15% or something, and we agreed on 10%. Later on, we reduced our rate, but we did not renegotiate the agreement. And that's why sometimes you have a place where the amount in the treaty could be higher than the domestic rate. Thank you.
Okay.
Okay.
Okay, so it's 12 o'clock now. There are still a couple of questions, but for all attendees that your questions have not been answered, it will still be answered. So rest assured. Maybe just to take one point, what is that one point you want attendees to walk away with? Just one point. I'll start with Dauda.
Okay. Thank you very much. I think one point to walk away with is I would advise attendees that now there's a lot of transparency when it comes to cross-border tax issues because of the issues of exchange of information between countries and all that. So I would advise attendees or multinationals to be very transparent themselves in their tax dealings. I would further advise that they should ensure proper and detailed documentation, because when there are disagreements or there are different interpretations, it is the evidence or your documentation that probably would help you. And lastly, where you are still in doubt, don't forget to quickly run to your advisor or to the regulator. Thank you very much.
Thank you, Mr. Noah.
Okay, thank you. What I want to say is that thank you to UK GCC for organizing this program. As I mentioned earlier, there are quite a number of things happening on the international scene. We will do our best to update the public and all stakeholders as things unfold so that they will not be caught by surprise in any of these things. Thank you.
Okay, last but not least, Nana.
Okay, thank you very much. I would just say that I think I concur with all the points made by my colleague Dauda and Danue, and just to add that I would advise participants to read the tax treaty itself when applying for the tax treaty benefit, and let's apply the tenet of the tax treaty itself without looking at, of course, the commentaries are there, the models are there, but it is an agreement between two states, and it's the provisions of those agreements that we are going to rely on to, and like just to reiterate the point made by Council Dauda that let the documentations and the transparency be there so that it makes the process quite faster for us. Because if you keep information from us and related party transactions and you wait for GRA to come and ask you questions, then we are prolonging the process. So let's read the treaty itself, apply the treaty itself, and let's be transparent, with the tax authority. Now we are partners. not a taxpayer and a tax authority. Thank you very much.
Thank you, Nana. So let's read the treaty very well and let's read the treaty itself. And on that note, I would like to sincerely thank our speakers for sharing their time, their insights, and practical perspective with us today. It has truly, truly been a thought-provoking discussion. And I believe many of us will leave with a much deeper appreciation of the opportunities and complexities surrounding double taxation agreements in Ghana and the wider international landscape. So on behalf of the organizers UKGCC and PwC Ghana, thank you once again to everyone who joined us and contributed to today's session. We truly appreciate your time and engagement. We hope the conversation has been both informative and valuable, and that it will continue to shape discussions and decisions in your perspective organization. On that note, thank you once again.
Thank you.
Thank you very much.
Bye.
Thank you.
Thank you.